Today, we're diving into business development companies, which are investment firms that help small and mid sized companies to grow. So imagine that I own a company called the Canine Confections Company, and I make delicious treats for your dogs. But I need funds to expand my business because I'd like to open a new location. Canine Confections can turn to a BDC, which would invest in my bakery, providing the necessary capital for me to grow my business. And in return, the business development company gets a slice of my company's profits, or they charge me interest on the money that I borrowed. I get to grow my business, and they get to earn a tasty return on their investment. So let's take a look at our first BDC, which is one that I hold in my portfolio, Main Street Capital, which is actually a monthly payer, which can be appealing to some investors. They offer debt and equity financing, supporting companies in various industries, including manufacturing, healthcare, and business services, often with a focus on family-owned businesses. Currently trading at $42.13, you can see that Main Street Capital is actually up in share price by 17.05% in the last year. Looking at the dividend rate, you can see that they're paying out $2.88 each year for each share that you own. The dividend history dates all the way back to November 13th of 2007. And if we look at the history in the last year, you'll see that we've actually received 16 payments, so monthly payments, and then we've got some special dividends popped in the middle there. So here in March, we received 18 cents per share. In June, an additional 23 cents per share. September, 28 cents per share. And coming up on December 18th, we'll get another 28 cent per share special dividend. And in the last 10 years, they've beat the S&P 500 for a total return with 182.64%. At least 70% of a BDC's total assets must be invested in eligible small or mid-sized private or public U.S. companies, as well as cash, cash equivalents, and government securities. It's set up this way because the purpose of the BDC is to support those small and mid-sized businesses. BDCs are also required to distribute a minimum of 90% of their taxable income to shareholders in the form of dividends. And because BDCs are not taxed at the corporate level, shareholders will bear the weight of the distributions and will be taxed at their ordinary income level. So if your goal is tax-free growth, perhaps keeping BDCs in a Roth IRA might be a good choice if you qualify based on income limits. Next, let's take a peek at Ares Capital Corporation. Their focus is direct loans to private middle market companies. They have an annual shareholder return of 13% and 490 companies in their portfolio. They're currently trading for just over $20 at $20.08, and in the last year are up in share price by 6.07%. They are a quarterly payer and are currently paying out at a rate of $1.92 for each share that you own. The current dividend yield is 9.56%. They have a dividend history that dates back to December of 2004. And have a 4-year average dividend yield of 9.61%. In the last year, they've grown their dividend by 14.29%, and they too have a total return in the last 10 years that's beating the S&P 500 at 194.7%. As I mentioned, they're invested in 490 companies that are spread across multiple industries, including healthcare, technology, consumer goods and services, industrials, energy, and telecommunications. Investing in business development companies can offer attractive dividends, a higher yielding investment, and exposure to smaller businesses, but it also comes with several risks that investors should consider. They can be influenced by broader market conditions. Economic downturns, market volatility, or changes in interest rates can impact the performance of the businesses they invest in, affecting the BDC's value and potentially those dividends we all love. The success of a BDC largely depends on the performance of its portfolio companies. So if my Canine Confections company fails and I default on that loan, it could negatively impact the BDC's earnings and ability to pay dividends, which is why it's important to find BDCs that invest in a diversified portfolio of companies so it can potentially decrease the risk. And because BDCs often use leverage or debt to amplify their investments, changes in interest rates can affect borrowing costs, potentially impacting profitability. Just like Main Street Capital, Gladstone Capital, ticker symbol GLAD, pays its dividends also on a monthly basis. Their target is lower middle market companies across the country in manufacturing, consumer goods and services, healthcare, tech, and energy. Presently trading for $10.41, they too are up in share price year to date, but by 5.68%. The annual payout is 99 cents for each share that you own, with a current dividend yield of 9.51%. The dividend history dates all the way back to December of 2001. And in the last year, they've grown their dividend by 16.04%. The 4-year average dividend yield is sitting right at 8.68%, and their 10-year total return is also beating the S&P 500 at 178.95%. And when we compare all three BDCs to the S&P 500 in the last 10 years, we see that ARK is actually the one that has the greatest 10-year total return. So do you have any business development companies in your portfolio? Let me know your favorites in the comments below, and then go and take a peek at this video next. Dividends. I've been receiving special dividends. Oh my heavens. My God, why can't I say That's all, folks.